In economic terms, that's called the declining marginal productivity of debt. It means every new dollar of debt is generating less and less output. Eventually, you hit a wall. You're borrowing not to create growth, but just to maintain what you already have. Let's take a moment here and bring it closer to home. Imagine your personal finances. If you take out a loan to build the business, that's productive debt. It can generate returns. But if you take out a loan to pay for groceries repeatedly, you're not creating future value. You're just deferring pain. Now scale that up to the size of an entire country. That's where we are. When interest rates were near zero, this debt binge didn't feel dangerous. In fact, it felt smart. The cost of borrowing was so low that governments and corporations could pile on debt without feeling the pressure, but the pressure was building. It just wasn't visible. It's like the body running on caffeine and sugar. You feel energized, but inside your arteries are narrowing, your heart is under strain, and then one day the palpitations start. We are now experiencing those palpitations in the global economy, and they're not coming from a sudden event. They're coming from long-term structural dependencies that we chose not to confront until we couldn't avoid them anymore. What makes this moment different isn't just the amount of debt, it's the structure of it. We're now at a point where a debt is being issued just to service previous debt. In the US alone, over $1 trillion per year is being spent just on interest payments. That's not building bridges or investing in the future. That's paying the tab for yesterday's meal with another credit card. This is the hallmark of a late-stage debt cycle. It's not cyclical, it's systemic. When you reach this point, your options narrow. You can't grow your way out of it fast enough. You can't cut your way out without severe political and social consequences, and you can't inflate your way out without risking a loss of trust in your currency. This is the kind of financial fragility that doesn't show up in quarterly reports. It shows up in the long arc of history, in the slow unraveling of empires that once believed they could borrow forever without consequence. And here's the subtle danger: because it happens slowly, it's easy to ignore until it's not. You feel fine until you don't. That's the reality of stimulant-driven economics. You push past the warning signs because the system rewards short-term performance, but nature and economics have a way of self-correcting. And the longer you delay that correction, the sharper it becomes. So what does this mean for us? It means we need to think differently, not just about monetary policy or fiscal deficits, but about incentives, about feedback loops, and about what kind of system we are actually building. Because we're not just managing numbers, we're managing trust. And once trust erodes, no amount of printed money can bring it back easily. Debt at its core is a promise about the future, and the deeper our dependence becomes, the more we place that future in jeopardy. In the next part, we'll examine the illusion that made all of this seem sustainable for so long, and why that illusion is now beginning to unravel. There's a powerful idea that's quietly shaped the last 2 decades of economic behavior. It's this: we can always print more money. In theory, it sounds like a kind of financial alchemy. If governments need more cash, central banks can simply create it. Problem solved. At first glance, it seems efficient, even elegant. But in practice, it builds an illusion, one that's deeply seductive, dangerously deceptive, and increasingly difficult to maintain. Let's explore why. For much of modern history, especially since the 2008 financial crisis, governments have run persistent deficits, not just in times of war or emergency, but during periods of relative peace and growth. And these deficits were increasingly financed not by real investor demand, but by central banks themselves. This is called the monetization of debt. Here's how it works. The government issues bonds to raise money. The central bank then buys those bonds, injecting cash into the system. This has 2 immediate effects. It keeps interest rates artificially low and ensures liquidity remains plentiful, and in the short run, that can be stabilizing. It softens downturns, buoys asset prices, and gives policymakers flexibility. But here's the deeper truth: it creates a false sense of security. When interest rates are suppressed, borrowing appears painless. When markets are backstopped by central bank purchases, risk appears diminished, but the risks haven't disappeared. They've just been redistributed and delayed, and like all illusions, This one has limits. Today, we're reaching those limits. The cost of servicing U.S. debt is now spiraling, exceeding $1 trillion per year in interest payments alone. That's more than the entire federal government spends on national defense. And this isn't money that's building new infrastructure, funding, research, or driving productivity. It's just the interest on prior decisions, debt on debt. Worse still, much of this financing has occurred under the assumption that interest rates would remain low indefinitely. But that assumption is breaking. Inflation has returned, and now central banks are facing a painful dilemma. If they continue raising rates to fight inflation, the cost of debt service explodes. If they cut rates to ease debt burdens, inflation accelerates again. Either path leads to instability. That's the trap. We've structured our entire economic system around the belief that monetary policy can always save us, that central banks will intervene, stimulate, and smooth over any crisis. But as inflation persists, those tools are losing their potency and the room to maneuver is narrowing. Let's think of it this way. Imagine trying to land a plane on a runway that's getting shorter with every passing second. You need precision timing and just the right conditions. One miscalculation and you're off the edge. This is the precision game central banks are playing right now, but their instruments are blunt and the variables increasingly outside their control. The market sees this. That's why bond yields are rising not just due to inflation expectations, but because investors are demanding a higher premium for holding government debt. They're saying, if you're going to keep borrowing at this pace, we need more compensation for the risk. That shift is profound because it strikes at the heart of what makes fiat systems function: trust. When trust in fiscal discipline erodes, borrowing becomes more expensive. When trust in monetary policy erodes, inflation becomes entrenched. And when trust in both erodes, the currency itself becomes unstable. We've seen this in history many times before, from Weimar, Germany to 982nd Latin America to more recent examples in Turkey and Argentina. Once the market begins to doubt the sustainability of a country's debt path, things can unravel quickly. Now, to be clear, the U.S. is in Argentina. It has advantages: its reserve currency status, deep capital markets, and a still strong institutional framework. But even empires have limits, and when deficits grow large, not because of emergency stimulus, but because of structural political gridlock and entitlement overspending, the path forward narrows. That's what makes this moment different. The illusion of sustainability, the idea that we could indefinitely monetize debt without consequence, is colliding with reality, and reality is unforgiving. We are now borrowing more simply to cover past borrowing. The growth we're financing is weaker, the inflation pressures are stickier, the political incentives are more short-term, and the central banks that once looked omnipotent now look cornered. This is not a forecast of collapse. It's a recognition of fragility. Fragility means that small shocks can cause large disruptions, that trust once lost is hard to regain, and that systems built on illusions eventually face reckoning. The key insight is this: illusions work until they don't, and once the market begins to reprick risk, it doesn't do so gradually. It happens all at once. So we must ask ourselves, how close are we to that point? What are the signals telling us? In the next part, we'll explore how inflation, once dismissed as temporary, has become a structural challenge, and why inflation is never just about prices. It's about psychology, behavior, and the erosion of belief. Let's talk about inflation not as an economist might define it, but as it actually behaves, because inflation isn't just a number. It's not just what you see on the gas pump or in the price of groceries. Inflation is an idea, a belief, and when that belief shifts, so does everything else. In the early stages, inflation can be quiet, almost invisible. A few percentage points here or there. Policymakers label it as transitory, and the public, conditioned by decades of low inflation, tends to agree. But inflation is like a small leak in a dam. If left unrest, the pressure builds, and at a certain point it becomes self-reinforcing. Why? Because inflation is deeply psychological. It's about what people expect their money to be worth tomorrow. When workers believe prices will rise, they demand higher wages. When businesses believe their costs will rise, they raise prices in advance. When lenders anticipate the erosion of purchasing power, they charge higher interest to compensate. These aren't irrational reactions, they're rational responses to a new belief system. This is what we call a regime shift. Once inflation embeds itself in expectations, it becomes systemic. You can't fight it with words or optimism. You have to fight it with credibility, and credibility once lost is hard to regain. Let's look at the challenge central banks now face. For years, they were able to stimulate growth with low rates and quantitative easing. It worked in part because inflation remained subdued. That gave them flexibility. But now that flexibility is gone, and the playbook has changed. If they raise interest rates aggressively to fight inflation, they risk slowing the economy, increasing unemployment, and making the debt burden more costly. If they hold off or ease prematurely, they risk reigniting inflation, weakening the currency, and undermining trust. This is the théorème: fight inflation, support growth, or maintain financial stability. But in this environment, you can't do all three at once. You have to choose, and each choice comes with pain. This is where things get uncomfortable because we've spent years avoiding pain. We've pushed it out into the future with stimulus, low rates, and policy promises, but the future has arrived, and now the trade-offs are unavoidable. What makes it more dangerous is that inflation rarely arrives in isolation. It often comes at a time when debt levels are high, political institutions are polarized, and global coordination is fraying. Why? Because inflation doesn't just test economic systems, it tests the social contract. It widens inequality. Those who hold assets, stocks, real estate, gold see their wealth increase. Those who live on fixed incomes or earn wages that can't keep pace with inflation fall behind. The result: frustration, resentment, division. Inflation becomes not just an economic issue, but a political one. Leaders begin promising short-term relief, price controls, subsidies, debt forgiveness. These measures may ease the pain temporarily, but often worsen the structural problem. They signal to markets that discipline has eroded, that long-term planning has been replaced by short-term survival, and the markets respond. They demand more compensation for risk. They retreat from long-dated commitments. They become jumpy, volatile, and cynical. That's what we're seeing now, a deepening sense that the rules are changing, that what used to work, what used to feel stable is now up for debate, and this brings us to a critical inflection point. How do you rebuild trust once it starts to fray? You do it not through more promises, but through clear, credible, and sometimes painful action: raising rates, cutting deficits, rebalancing entitlements, being transparent about trade-offs. These are not politically easy choices, but they are necessary if we want to anchor expectations, restore policy credibility, and prevent inflation from becoming a runaway dynamic, because once inflation becomes embedded, it creates a vicious cycle. Higher prices lead to higher wages, which lead to higher costs, which lead to higher prices. Breaking that cycle requires resolve. It also requires something more rare: humility. Policymakers, investors, and citizens alike must recognize that we've been living in an unusually benign environment for decades. Low inflation, low rates, high asset prices. It all felt normal, but it wasn't normal. It was a particular moment in a much larger cycle. That cycle is now turning, and the tools that worked in the last chapter may no longer apply in this one. In the next part, we'll look at how that turning is manifesting across markets, not just in one asset class, but everywhere. We'll examine what it means when everything starts to sell off at once, and why those moments signal not just volatility, but transformation. In the markets, most downturns are localized. A sector falters, a company disappoints, a currency wobbles. But every so often something different happens. Everything starts to fall at once. Stocks, bonds, currencies, even traditional hedges like gold. These are not ordinary corrections. These are messages, and we must learn how to read them. Because when all assets begin to sell off simultaneously, it suggests that the system itself is being repriced. Let's unpack why. For decades, asset valuations have been supported by a simple and powerful mechanism: declining interest rates. When rates fall, the present value of future cash flows increases. This raises the value of stocks, bonds, real estate, almost everything. It's not that fundamentals disappeared, it's just that liquidity, not discipline, became the primary driver of returns. And when central banks made it clear they would support markets cutting rates at the first sign of weakness, injecting liquidity through quantitative easing, the game became clear. Risk was no longer about economic conditions. It was about policy timing. You didn't need to understand every balance sheet or macro trend. You just had to ride the wave of liquidity, and it worked until it didn't. Today, that tide is receding. Inflation has forced central banks to reverse course. Interest rates are rising, liquidity is tightening, and as a result, the foundation on which asset prices were built is shifting beneath our feet. That's why we're seeing this broad-based sell-off. It's not a sign of individual failure. It's a signal that the assumptions underpinning the entire system are being questioned. Let's break that down. When interest rates rise, stock valuations come under pressure. Future earnings are discounted at a higher rate, reducing their present value. But it doesn't stop there. Bonds, especially long-duration ones, suffer too. Rising yields mean falling prices, and the safe haven protection they once offered begins to disappear. Real estate, which thrives on cheap credit, begins to slow. Buyers pull back, financing costs rise, cap rates adjust. Even gold, traditionally a safe haven during inflation, can sell off, especially in liquidity crunches when investors are forced to raise cash quickly. It's not about gold losing its role. It's about the mechanics of leverage and liquidation. And then there's the currency market. When trust in fiscal sustainability wanes and real interest rates don't compensate for inflation, risk currencies weaken, capital flows out. Investors demand higher returns to stay, and that in turn pressures yields even further. All of these forces are interlinked. This is not a sectoral story, it's a systemic one, a reflection of a global market adjusting to a new paradigm. One where easy money is no longer a given, and where the cost of capital has meaning again. It's important to understand that these moments of repricing don't happen overnight. They build slowly. First in the data, then in the tone of central bank speeches, then in the yield curve, and finally in the markets themselves. What accelerates them is positioning. Because when everyone has built portfolios based on the same assumptions, low inflation, low rate, central bank backstops, then when those assumptions break, everyone has to adjust at once. Funds delever, hedge funds rebalance, pensions reallocate, retail investors panic, algorithms trigger sell-offs, the feedback loop takes over, and suddenly what looked like a healthy market begins to convulse. We saw this dynamic in 2008. We saw it again during the pandemic crash of 2020, and we are seeing it now though. This time the cause is not an external shock, but the internal unwinding of excess. That's why treasuries, once the safest asset on the planet, are now flashing warning signs. Not because they're about to default, but because their real value is being questioned. In an era of persistent deficits and inflation, even government bonds are no longer risk-free in the way we once believed. This is the essence of a systemic shift. It's not just about lower prices, it's about lower confidence. The rules that govern the last cycle, easy credit, abundant liquidity, rising multiples, are no longer reliable. And when belief systems break down, markets don't just correct, they evolve. That's where we are, a phase where the traditional playbook no longer fits the game, where diversification based on historical correlations begins to fail, where even prudent portfolios feel stress. But there's a deeper insight here. This isn't just a financial transition, it's a signal that the economy, the political system, and the geopolitical order are all adjusting in tandem. And when multiple cycles converge, the resulting volatility isn't just noise, it's information. In the next part, we'll zoom out to examine that convergence. How economic fragility, political polarization, and global realignment are all feeding into the same moment, and what that means for the system as a whole. If you look closely at history, not just the events, but the rhythms beneath them, you'll begin to see a recurring truth. Systems don't unravel from one cause alone. They unravel when multiple large forces, economic, political, social, and geopolitical, begin to shift at the same time, and instead of offsetting each other, they amplify one another. That's where we are now. We're not just in a late-stage debt cycle. We're in the overlapping end phases of several major cycles,